Hi, Assalamualaikum. We are from group MAC204E. Today, our group will present the group project for MAF603. I'm Nuruzawana binti Badunisam. Before we go through the answer for the case study 1, I would like to read the question first. New waves of the COVID-19 outbreak in major parts of the world may have sparked fear of a double-dip recession, but Trademark Autoberhad, the official distributor of Mazda cars and spare parts in Malaysia, remain optimistic that the global economic growth is on track. Due to that, Trademark Autoberhad is considering three possible financing arrangements to raise 100 million ringgit of new capital for its business. Alternative 1, finance with only new equity. Alternative 2, finance using 50% debt and 50% equity. Alternative 3, finance using only new debt. The proceeds may be utilized to finance working capital requirements, investment, acquisitions, capital expenditure, and general corporate purposes. Currently, the capital structure consists of no debt and 250 million ringgit in equity. There are 100 million shares of common stock currently outstanding, selling at 2 ringgit and 50 cents per share. Expected earning of 200 million ringgit before interest and taxes are expected for next period. The interest rate on any debt obtained should be 10% and the tax rate is 25%. Next, the first question for the case study 1 is calculate the earning per share for each alternative. For alternative 1, finance 100% of equity. Based on the question, we can determine the earning before interest and tax, which amounting to 100 million ringgit, and there are no interest on the alternative 1 since there are no debt. And then we can get earning before tax equal to 200 million ringgit, and we need to deduct tax amounting 50 million ringgit, and we get earning after tax amounting 150 million ringgit. So in order to get the earning per share, we need to use the formula net profit divided by number of shares, which earning per share for alternative 1 equal to 1 ringgit and 50 cents. Next for the alternative 2, finance 50% of debt and 50% of equity. Earning before interest and tax amounting 200 million ringgit need to less interest amounting 5 million ringgit. So we get earning before tax 185 million ringgit. So 195 million ringgit need to less with the 25% tax amounting 48,750,000 ringgit. So as a result, earning after tax, we get 146,250,000 ringgit. So the earning per share for the alternative 2 equal to 1 ringgit and 46 cents. Alternative 3, finance 100% of that. The calculation of the alternative 3 is same with other alternative, but the interest is a bit different because alternative 3 finance 100% of that, so 100 million ringgit times with 10% equal to 10 million ringgit. So we get the earning before tax equal to 190 million ringgit. After deduct the tax, earning after tax, we get 142,500,000 ringgit. So the earning per share for the alternative 3 equal to 1 ringgit and 43 cents.
Assalamualaikum, my name is Suan Syairah. For case 1, question B is to determine the distribution of income between the debt holders, shareholders, and the government for each alternative. The first alternative is where the company finance only the new equity. When the company only finance the equity, therefore, there is no income for the debt holders. So it will be nil. And the earning per share for alternative 1 is 1 ringgit and 50 cents times with 100 million shares. So the shareholders' income is RM 150 million. The government income is the amount of tax that the company pay, which is RM 50 million. The calculation to get this amount is earning after interest of RM 200 million times with 25% of its tax rate. The second alternative is where the company finance 50% of the debt and another 50% for its equity. Thus, the income for the debt holders is RM 5 million. The calculation to get the amount is 50 million of the debt times with 10% of its interest. For the shareholders' income is RM 73 million, which is the earning per share of RM 1 ringgit and 46 cents times with 50 million of shares. The government income for the alternative 2 is 48,750,000. To get this amount is RM 195 million times with 25% of tax rate. We can see that when there is debt, the amount of tax to be paid is decreasing. Finally, for alternative 3, the company only finance new debt. Hence, the income of the debt holders is RM 10 million, which is 10% of interest rate times with 100 million of the debt. For the shareholders' income will be nil. Lastly, the government income is 47,500,000, which is the earning after interest is RM 190 million times with 25% of tax rate. The tax is also decreasing when the company took more debt.
Assalamualaikum. I am Nur Imanina binti Azmi, and today I am going to present the case 1 question, C question. Okay, I read the question first. In view of the benefit and expense of debt funding, the corporation agreed to issue an additional debt of 60 million, resulting a debt equity ratio of 1.5 primarily for the purpose of increasing its capital requirement. By applying a Modigliani Miller proposition, calculate the value and the overall cost of capital of Trademark Auto Berhad. Okay, Trademark Auto Berhad is identified as a levered company with tax, since in the question give the debt amount and tax rate with 25%. Okay, according to MM proposition, for the proposition 1 is to calculate the value of the firm, and then from the previous question give 100 million as a debt, and then from the C question state that issue an additional debt of 60 million. So we have to add the 60 million with 100 million before. In total, the debt amount is equal to 160 million. And the question give us debt equity ratio is equal to 1.5. Debt equity ratio means debt divided by the equity equal to 1.5. Since just now we calculate the debt amount is equal to 160 million. So to find the equity amount, so we have to divide debt 160 million with 1.5. So the equity amount is equal to 106,666,667. To calculate the value of the firm, apply the formula of a value equal to B plus S. B is debt and S the equity. Debt equal to 160 million and equity is equal to 106,666,667. And total value of the firm is equal to 266,666,667. Next, proceed with the calculation of the overall cost of capital by apply the formula of RWACC equals to EBIT in bracket 1 minus TC. TC is the tax rate and divide by the value of the firm. Okay, EBIT is equal to 200 million from the question, and in bracket 1 minus 0.25 divide by 266,666,667, and the answer is 0.5625, and the answer of the overall cost of capital of Trademark Auto Berhad is equal to 56.25%.
I will continue with the last question for the case study 1. Explain why debt levels vary across sectors and within industries. Debt levels vary across sectors within industries because there are some industries are more capital intensive than other industries, and types of industries that are more likely to have high leverage than other industries are airlines, financial sector, utilities, and etc. Next, debt levels vary across sectors within industries because some industries have nature of business that can demand on higher debt than other industries. Example that can show the industries can manage in higher debt is utility companies, where they generate a consistent revenue, therefore the demand of their services largely constant irrespective of any economic condition. That's all for the case study 1. Thank you.
Hi and Assalamualaikum. My name is Muhammad Fikri Nasrullah bin Zulkarnain, and I'm going to present for case 2, question A. So for the question for case 2, Randy Property Berhad is planning to invest in a project which would involve diversification into a new industry. Due to rising health cases nowadays, Randy Property plans to increase business focus in the industry related to healthcare, that is on the diagnosis and remote monitoring of heart rhythm disorders. It will become part of Randy's connected care business, which offers a range of platforms and devices that allow patients to stay at home while being monitored. The management of Randy Property Berhad expected to deliver double-digit growth and improve its earnings before interest and tax to more than 20% by 2025. The finance manager of the company has analyzed two companies that are identical every in every respect except for their capital structure. The market values are in equilibrium as follows. So the total value of geared is higher than the total value of ungeared, which is consistent with MM. All profits after tax are paid out as dividends, and so there is no dividend growth. The beta value of ungeared has been calculated as 1.0. The debt capital of geared can be regarded as risk-free. So for question A1, we are required to calculate the cost of equity to the equity holders in the geared company. So in order to calculate cost of equity, we need to find RO first. For that, we are using this formula. Since all the information has given, which is VL is 8.08 million, and earning before interest and tax is 1 million, and debt is 4.18 million. We need to use the information to calculate RO. So the RO here is 10.66%. So after we calculate the RO, we can calculate the RS by using this formula. So the RO we just calculate is 10.66. We plus it with V, which is debt, 4.18 million, and we times it with RO minus RB, which is 10.66 and 8%. And we times it with 1 minus the tax rate, which is 0.25. Then we divide it with 3.9 million. So the RS we get here is 12.8%. So for question A2, we are required to calculate the beta value of geared using the asset beta formula and explain the calculated beta. So this is the asset beta formula. To calculate the beta value of geared, first we need to calculate the beta for ungeared. So by using this formula, we can get that beta for ungeared is 1.0. So after we calculate BA, which is for ungeared, we need to use it to get new BE, which is beta for geared, in our capital structure. So to calculate beta for geared, we use the BA that we just calculate with 1.0. We times it with VE plus VD times 1 minus TC, where VE is value of equity is 3.9 million. We plus it with VD, which is 4.18 million, and we times it with 0.75. And after that we divide it with VE, which is value of equity again, 3.9 million. And then we get the beta for geared company, which is 1.8. Therefore, the risk for geared company tend to be higher than the risk of ungeared, because this can be proved by comparing the beta between the two company, which is the beta of geared company 1.8 is higher than the beta of ungeared company, which is 1.0.
Assalamualaikum warahmatullahi wabarakatuh. I'm Diana Shaira, and I'll be explaining the leverage and the implication to companies if earnings are insufficient to cover interest obligation. Financial leverage is the use of borrowed money to finance the acquisition of assets. So, when the company's earnings are insufficient to cover interest obligation, the leverage will increase and impact the return on equity. If earnings are insufficient to cover the interest obligation, this will lead to financial distress as the company fails to pay its obligation and place it at a risk of bankruptcy. Therefore, it will also lead to a decrease in the return on equity (ROE). As a result, the value of companies' equity could also be declined.
Hi, I'm Anis Fatima, so I will continue to the last question C. Discuss the relationship between financial distress and capital structure and propose the consideration to be addressed by using debt financing. Financial distress happens when a company has more debt than equity. Debt in a company's capital structure may be a good way to finance its operation, but it does come with risks, like bankruptcy. Bankruptcy costs arise when there is a company default on its financial obligation as it has decided to increase debt financing rather than use equity. Consideration to be addressed by using debt financing is risk involved, which is debt financing requires firm to make periodic payment to lender, which includes interest, principal, or both. So if a firm is unable to make this payment, it might be forced to bankruptcy. That's all, thank you.